Hello, everyone. I'm Ted Oakley here at Oxbow Advisors, and I have a repeat appearance this year by Jim Bianco. Jim was here in the early summer with some really great thoughts, and we had a tremendous amount of people that wanted to see him again, and we wanted to wait until after the election. He's had a lot of good information on the economy and the bond stocks, the election, COVID, and the whole thing. And I think what you'll find today is that Jim has some comments today that'll be really good for you as investors. But Jim, I want to welcome you back.
Thanks, Ted. Thanks for having me.
Yeah, for sure. Let's kick it off and tell me where you are, where you think we are economically regarding what's going on in the economy relative to COVID and the whole thing.
Economically, I think we're in a okay place. Unfortunately, heading to a worse place. And what I mean by an okay place is we've had the V bottom, and it appears that the V bottom is really slowing down and stalling right now in terms of where we're going to go next. It's not reversing. It's just taking its sweet time to recover a little bit more. The problem is that the next thing that's coming seems to be a rise in COVID cases, a rise in COVID deaths, unfortunately, more lockdowns, and that should further impact the economy negatively as we move forward from here. So the next couple of quarters are going to be a real challenge, especially for people that don't work at home, because we're going to start to see some rollbacks. We've already seen the New York City schools close. We've seen schools in a lot of other cities close. We've seen restaurants close as well, too, and we've seen a market decline in people's mobility. They're not willing to travel as much. They're not willing to go out as much as well, too. And that's all going to start to drag on the economy one more time.
Well, let's take, you have some things for us on the economy that you put together on GDP and COVID and some various things that you might share with us.
Yeah. So what I was going to show you is, let me start with this chart right here. This is GDP, and normally GDP would be around 2.5 or 3% pre-COVID. 3.5 or 4% would be a pretty decent pre-COVID type of period. Now, if you go back and you look at this chart, this is estimates for the fourth quarter, for the first quarter, second quarter, third quarter of 21. So this is Wall Street's guess as to where they think GDP is going to go. This guess was updated yesterday, so it includes all of the vaccine announcements that the economists now understand putting in their forecasts. Back in the summer, we were expecting some pretty decent GDP numbers, 7% in the fourth quarter, somewhere around 5.5% in the first quarter, and above 4% for the rest of the quarters. Currently, nothing is above 4%, and all of the numbers have been moving lower. Now, normally, 3.5%, 4% growth would be really good. But the problem is, as the next chart shows, here's the economy. Here's real growth in the economy. The natural natural tendency for the economy is to always expand. It should always be expanding. There's more people coming into the economy. The population is constantly growing. This chart here shows you a drawdown. What that means is how far off of the high is the economy. Every time the economy dips, you have a shaded area, which is a recession. So those are the recessions. This goes back to World War II, this chart. Here's the last recession, the Great Recession of 2009. The economy contracted by 4%. That was the worst we've seen since World War II. By the second quarter, because of COVID, it contracted 10%. And it's currently still 3.8% off of its high. Now, why did I bring that up? In order to get back to the old high, just to get back to the old high, it's going to take all of next year with those 3.5%, 4% growth rates. So the economy is going to be running below its potential for quite a while. To put it in another estimate, at the bottom in April, 21 million people had lost their jobs because of COVID. That's been cut in half to 10 million people. That's the V bottom we've had. If you go by Wall Street's estimates, updated through yesterday, they know we've got the vaccines coming. Still, almost 5 million people will have lost their jobs from COVID and not get them back at the end of 2021. That's what I mean by that. We're going to be stalling out and we're going to be slowing down. We're not reversing, but we are going to be taking a lot more time to get back to some kind of pre-COVID level. And that is going to probably weigh on a lot of people's psyches and a lot of emotions and the economy as well too. Yeah, things are getting better, but they're not getting better for me. When do I get my job back? That's going to be a real problem, I think, as we move forward through 2021, especially once the vaccines start and then people start asking that question all the more. Why am I not getting my job back? And it seems like it's going to take a little bit more time than everybody's hoping right now.
And how do you see COVID affecting that? I mean, how would you think that would play in?
Well, COVID is a real problem on two fronts. On one front, people are very aware of what's going on with COVID. Let me show you my COVID chart here real quick. There's the last case count for COVID. And we're up to around 155,000 cases a day. We peaked out last summer at 75,000 cases a day. And in the spring, we peaked out at 40. So we practically doubled from the summer and we practically doubled again. People know this. They know what's happening with COVID. And as the case count goes up, there is a natural reaction within the mobility data. What's mobility data? Apple and Google, they have location services. This is my phone. They have location services on your phone. They actually can track how much your phone moves around during the day. And they don't publish that data individually. They do publish it in aggregate. And we could see that as case counts go up in certain regions, the amount that people move around goes down. They just stay home. They're just afraid to go out because of the case counts as well, too. Then you add in governments react. Now, whenever I talk about cases, a lot of people will say, well, yeah, but the positivity rate is this and the death rate is that, and the therapeutics are getting better and it's not as lethal. All that's true. All that's true. And I would argue to you that maybe this version of case rises is not as bad as we've seen in the past. But the fact of the matter is the fastest way to become an ex-politician is to watch the case counts double and then just say, hey, there's nothing to this. It's just the flu. Everybody go out and have a good time. So they will naturally close the schools, close the restaurants as well. So that will drag on the economy too. As I like to say as an economic forecaster, I'm not here to moralize whether it's right or wrong. Should they be closing the schools or closing the restaurants? I'm here to say that's what they will do when the case counts go up, and that will drag on the economy as well. So it's a twofold thing. It's not just we're waiting for the governor or the mayor to tell us we can't go to restaurants. People know that case counts are coming up, and they'll just naturally not want to go in the first place. And then after that, we'll see some kind of reaction from government.
I'm going to switch now. One of the things you made early on, one of the very first people to do this, were to talk about inflation returning. Yeah, people talked about it, but everybody said, no, that's 3 years from now. Don't worry about it. Fed's going to take care of everything. But yeah, you were early, some months back, and said, hey, we're going to start reinflating again. And you might talk about some of that and then share some of those graphs you have on that.
Yeah, so inflation is a interesting thing to talk about. And let me start by showing you this chart right here. And what I want to point out when I talk about inflation, this is what you're looking at here is core PCE. This is the Fed's favorite measure of inflation. This excludes food and energy. We'll go with that. I mean, there's an argument to make we shouldn't do it, but let's just go with that for right now. This chart goes back 27 years. The highest level we've seen in the last 27 years is 2.5%. So and it's currently now at 1.5%. So what is inflation? It's 2.5% on core PCE, to use the Fed's favorite measure. When I say inflation, there are people of a certain age, 10, 12, 14% inflation. No, let's start with 2.5. That's a 27-year high. That's not a lot of inflation versus the last 100 years. It is a lot of inflation versus the last 25 years. So let's just put that kind of definition on it.
One of the things I was going to say here is that, just for the audience, is that most of you understand this, but most of what they see usually is consumer price index, but the Fed uses personal consumption expenditures, and they always have, and I'm not certain. You probably know the reason why, but they've always used that instead. It's off a little bit. It's a little different, but I just wanted to make sure they understood what that PCE stood for.
Yeah. So let me just quickly say, the Consumer Price Index is an index of prices, and there is literally in the Department of Commerce hundreds of people that go around as job as price checker, and they look at prices every month, whether it's literally going through the prices in a grocery store or looking at prices online, and then they put them in a database. They calculate the CPI. The personal consumption, or PCE, personal consumption expenditures, or PCE, uses the same raw database.
Well, and that brings us to this. Regarding inflation, which keys off into interest rates, and back when the bonds hit in the 30 and the 0.3 handle on the 10-year, when the rates were hit that low, you were the only person I know of, and I'm sure there probably may have been one or two more. The only person I know of that said that's it. That's it for the 40-year bond bull market, and so far you've been right. You've taken them on up. So you might give us a few slides and some comments on that.
Yeah. So in looking at the 10-year yield, here's the 10-year yield. This is what you're looking at here is March 9th, when it hit 33 basis points. And literally, that's the range on March 9th. A couple days later, it hit 125, and then it came back down. That was a spectacular way to end a 39-year bull market. And I've argued that's the low. We're not going to see interest rates go below that. The caveat I would give you, when would I be wrong on that? I would probably be wrong on that if we do have a severe second recession in 2021, because the COVID cases spike, problem with the vaccine, people get very scared, or some or all of the above. But short of that, I don't think we're going to see that level again. Since August, you've seen rates start to creep irregularly higher, from 50 basis points to 90 basis points. Now, 90 basis points is nothing to get right home about, but I do think that the trend is going to stay higher in interest rates, and it's going to keep going up as we look at it from here. And I suspect that inflation is going to be the story as we move forward. This is different. This is new. Most people on Wall Street, as I said, we haven't had inflation for 25 years. So there's the reason that interest rates are at, if you look at a country, you go, why is an interest rate in this country at 10%, an interest rate in this country negative, and an interest rate in this country 4%? And the answer that economists would give you, and I think is largely right, is expected nominal growth. I'm going to use a fancy word, but I'll try and explain it. Nominal growth. The countries that have 10% nominal growth. The countries that have negative nominal growth. What's nominal growth? It's real growth, which is what we want, plus inflation. But for the last 25 years, nominal growth has been all about whether real growth has been going up or down. So if interest rates are going up because real growth is expanding, that's good for risk markets. That's something we want. And so Wall Street looks at interest rates going up and they go, good, go higher, because the assumption is more real growth is coming. But if we're about to turn to a period that the nominal growth is going to be more about inflation expanding, again, something we haven't seen in a quarter century, that's not so good for risk markets as we move forward from here. And that could bring interest rates up, and that could bother the stock market. It could bother the real estate market with higher mortgage rates as well too. So interest rates rising can be a good thing, but if it's really about inflation coming back, less supply, keep stimulating demand, pushing prices up, prices go higher, we're looking at 2.5% on core, maybe a little bit above that by next year, middle of next year. And then all of a sudden we turn around and we go, wow, and look at interest rates are at 125, 130, 135 as well. That might not be viewed as the positive thing. Right now, if you ask Wall Street and somebody you said to Wall Street, hey, you know, by middle of next year, interest rates are going to be at 135 on the 10-year note, they'd go, great. That must mean that the economy is roaring. Well, it can mean that nominal growth is going up. And the question is, in that mixture of real and inflation, what part of it's driving it? And what I fear is it's going to be the inflation part that's going to be driving it in 21.
And so, relative to that, I'm assuming you would think that the longer term rates, which they would go up 1.5% as well.
Yeah, I do think that they would and they could. And not to get too bond mathy on you here, especially for investors, to talk about duration and convexity, and I'll throw out those fancy terms and I'll kind of give you an English language explanation for it. When interest rates get very low, a move from 90 basis points to 1.5, people might think about, oh, well, let's see, if my mortgage rate goes up or my car rates go up by 60 basis points, that's no big deal. But if you do the bond math and go, how much does a bond portfolio at very low interest rates lose when you go from 90 basis points to 1.5, it can be 3, 4, 5% on the long end of the curve. It can be rather substantial because of when interest rates get low, little movements in interest rates produce big movements in the price of the bond. That's called convexity. So from a bond investor standpoint, say move to 1.5% is a big deal. From a borrower standpoint, maybe you're borrowing for a business or a venture, and you might say, well, if the rates go up 0.5%, no big deal. Yeah, because your expected return is much higher than that, and that's not going to change it. But if you're talking about a bond portfolio, that does matter.
And the other thing I'll ask you real quickly is on the Fed, if they start to see the rates going higher, okay, which they can't control the long bond market, at least not yet anyway. And if they start to see those rates move higher, they sort of get stuck between a rock and a hard place, I think. But you might comment on that.
Yeah, so on the one hand, the Fed wants interest rates to kind of creep higher because they think, like everybody else, it's a sign that real growth is coming back because they don't believe that inflation is going to return. And remember, I'm giving you a forecast of inflation. Hasn't quite shown up yet, but my bet is that in 6 or 9 months, it will, and then that will produce those higher rates. So the Fed sort of wants interest rates to go up because it shows real growth in their mind, but they don't want them to go up too much. So they're going to try and walk this fine line of say, you know, we're going to let the interest rate market kind of creep higher because that's a good thing, but not too much. We've got all of these tools that we could use to try and manipulate the level of interest rates. One of them is that they are currently purchasing $120 billion a month of fixed income securities, 80 billion of treasuries, 40 billion of mortgages. They could extend the duration. They could buy more 10-year notes and more 30-year bonds as opposed to buying 2-year notes. They could talk about, and there's chatter that in the December meeting, the Fed might move to extend its duration, just buy more bonds to help kind of manage that. The other one is they could go to yield curve control, which is just simply, that's just price fixing. They'll just set a level for the front end of the curve. They'll say the 2-year note's now 10 basis points. The 5-year note's now 25 basis points. And they'll try and fix those levels. And then they'll buy and sell 2-year and 5-year notes in levels necessary to make sure that they stay at those levels. So that's what the Fed will attempt to do. Now, let me just quickly mention, the Fed can do that, and it can work as long as the market is not spooked. I've used this metaphor many times. Think of the Fed as a post in the ground, and if they put their post in the ground at 25 basis points, the 5-year note. And the market is a big 1,100-pound horse tied to that post. As long as that horse is not worried about anything or not spooked, it just stands there, tied to that post, and it doesn't go anywhere. That's what the Fed wants. You spook that market in any way, and in this metaphor, that's inflation, spooking the horse. that horse will rip that post right out of the ground and it'll run away or run wherever it wants to run when it's scared. So yeah, the Fed can have all these tools, and you'll hear Wall Street talk a lot about, well, the Fed won't let rates go up. Okay, that's true until the market gets worried that there's a thing called inflation, and it'll act like that horse, and it will just go, and it doesn't matter what the Fed does. We've seen this with other central banks like the ECB and the Bank of Japan when they've tried to do yield curve control and all of these other events. When their markets got spooked, they just went. And whatever the central bank tried to do could not stop it. So yes, they can, to a point, control these markets. And that point is when the markets are afraid of imbalances like inflation, and then they'll take over. It doesn't matter what the Fed can do. So that's the fine line that they're going to try and walk here as we move into 21.
And you know, Jim, you have one slide in there relative to commodities and the rate interest rates themselves. But I'm this is a question for you. But do you see those commodities following in and probably staying fairly strong in 21?
Yeah. So usually, and that's this slide I think you're talking about here. The orange line is the commodity index. The orange line is the commodity index right here, and the blue line is the 10-year yield. Now, normally, they move together with each other. So it's not that you could use one to predict the other one. They sort of move in tandem, and so you expect them both to generally go up and down together. But as I've shown here with the box, there's been a big break in that. Commodity prices are moving higher and have continued to move higher. Interest rates have only recently started moving higher, but not as much as you would have suggested from commodity prices. Part of the reason I've argued that that's been happening is the Fed's buying $120 billion of bonds a month. But if inflation comes back and commodity prices continue to drift higher, that will put more pressure on interest rates to go up. And if they're going up in conjunction with rising commodity prices, then I think what you'll see happen is more and more fear that maybe this rise is about inflation and not so much about real growth coming back. That'll be the story, I think, when rates go up. Initially, Wall Street will tell you, the Fed will tell you, real growth, it's really good, it's really good. And then all of a sudden, you're going to go, wait a minute, stop going up on rates. And then the story will say, wait a minute, maybe it's about inflation. Maybe it is about all the stimulus that we've pumped into the economy and all of the contractions in the stuff that we make is producing higher prices.
And you know, Jim, I've been around long enough to have seen inflation, so I have probably a different viewpoint than most people. But we have a whole generation of people in the investment business that have never seen higher interest rates, and in a way, a lot of them never seen a bad market. But interesting that it'll be interesting to see how they relate to that, because I think they've been on plug and play mode for about 15 or 20 years, and it's going to be interesting to see how they relate to that.
This matters for the wealth management community because a bedrock of what they've used for the last 10 or 15 years with client portfolios and has worked great has been the 60-40 portfolio, because the prices of bonds and the prices of stocks move opposite each other or negative correlation. So when the market rallies, you're 60% in equities, you get some upside. When the stock market declines, the 40% leg of the bond market rallies and it cushions you on the downside. That's worked great. The assumption that's made that work is no inflation. And that's what's caused that opposite correlation between prices of stocks and bonds. If you get inflation, and we looked at inflationary periods like in the 70s and 80s, the correlation between stocks and bonds moves together. So when the market rallies, you're 60% in stocks and bonds rallying too. You look and go, wow, I should be 100% in stocks. And then when the market declines, you go, okay, well, my stock portfolio is declining, but so it's my bond portfolio. I'm not getting any downside protection. Might as well not be in the market at all. So that is where I think the inflation story is going to matter, at least initially, is in that portfolio construction idea of a 60-40 portfolio and whether or not that still works. Currently, the evidence is mixed. It might be breaking down. It might not be breaking down. It's still a little too early to tell, but also remember, inflation is just a forecast. It hasn't actually materialized just yet, which I think it will as we move forward into 2021.
And that brings us to this sort of on a last subject, and you have a couple of really good slides on the S&P 500, the stock market here. I think you have some really good thoughts, which is where we are as a firm, which is we have a lot of liquidity right now based on exactly what you were talking about there, that you almost have to have liquidity to take care of these movements. In the late 70s and early 80s, I know what happened is if you didn't have liquidity, you really couldn't make much money because you just rode it up and down and up and down and you didn't get anywhere. I think if you look at people that have been in this business probably the last 20 or 25 years, they've never experienced that. And it'll be an interesting time to see, but you might talk about what you're thinking about on the market. You've got a couple of really good slides on that.
Yeah, so we've talked about the economy, we've talked about inflation, and I've talked about that inflation might be returning, and I've talked about how the economy might be struggling because of COVID. That might lead one to believe that the answer is, well, the stock market shouldn't be doing well in that kind of environment, but it is. It's rallied back to its all-time highs. Now, why is it rallied back to its all-time highs? Because the market is living in the second half of 21. It's saying, yeah, Jim, you're right. It's going to be, as Biden says, it's going to be a dark winter. It's going to be tough. It's going to be tough. There's going to be a lot of COVID cases. There's going to be a lot of shutdowns and everything else. But don't worry about it. We're going to get a vaccine in the spring. We're all going to get a shot in the arm, literally. And then by late summer, fall, we're going to start returning to some level of normalcy. And so therefore, let's all work on that assumption. It's going to be better by summer or fall. And you know what? I have no reason to doubt that that might come to pass. That, by summer or fall, we're going to have some kind of vaccine or maybe herd immunity or maybe a combination of the two, and that we could start returning to normal at that point. The problem is the stock market is starting at a level of very high, if not overvaluation. The forward PE ratio is 25. That is the last time we saw that level or something like that level, and the only time was the bubble peak of 2000. So the idea here is that things are going to get better. I agree. We might be behind this by the second half of 21. I agree. And so therefore, let's all, party like it's 1999 because it's all going to be all better. Hold on a minute. We're already at those 1999 levels that we were at when everybody understood, oh yeah, I understand why we had that bubble peak in 2000. The market got to these unsustainably high valuation levels. We're there now. And if you look at Wall Street is expecting us to stay there. JP Morgan is probably way out on the street right now. They expect that next year, the S&P 500, which is at 3,600, 3,550 now roughly, is going to end at 4,500, 1,000 points higher by the end of next year. They also expect earnings to be $178 a share for the S&P. That works out to a 25 PE at the end of next year. So the argument we're giving everybody is buy really expensive stocks because you'll be able to watch them get even more expensive. That's always possible. It's always possible. But boy, that's a tough way to make money in the stock market, to buy really expensive stocks, expecting them to be even more expensive. And by the way, I'm not just talking about chasing FANG stocks like Apple and Amazon and Netflix and the like, and Facebook. They're also making the same argument for traditional cyclical consumer discretionary financial energy healthcare companies as well too. Their forward PE ratio is even higher than the overall market. It's approaching 30. It's really a tough go when you want to say, let's go buy some energy stocks at a 30 PE, assuming next year's, remember, this is on 12-month earnings. So what this is we know there's a recovery coming. We know there's a vaccine coming. We know that there's a return to normalcy coming. We have already factored in a jump in earnings because of that, yet you're still going to be paying 30 PE or 28 PE for a lot of these stocks, hoping that in a year we're still at a 28 or 30 PE, if not higher, as the market moves up. And you're also hoping that interest rates don't move up too much too, because if they did, especially because of inflation, that could really upset the apple cart, because typically when rates go up, the PEs, or what we call Wall Street, multiples contract. You get multiple contraction as well too. So yes, it can happen. Yes, I completely understand the second half of 21 story and think it could be right, but you're not starting from a basis of value. You're starting from a basis of being expensive. And that's what's going to make it a tough road. That doesn't mean the market has to sell off. I'm not suggesting it's going to tank or anything. It's just it's going to be very difficult sledding to really say, oh no, we're going to have another 25% gain in the stock market between now and the end of next year. You're going to have to do that starting at a space of expensive stocks and ending at even more expensive stocks in another 14 months or so. That's tough to really make that case, I believe.
I know for Oxbow, we're using low numbers. Like we're thinking over the next 3 to 4 years that your average return on stocks, if not unless something changes dramatically, is somewhere like 3 to 5%, which it would not sit well with people, but that's what it looks like to us, and that's why we carry right now some fairly high and actually very high cash positions relative to where we have been.
I agree with you on that, because just historically, if you look at, we've done this study too. If you look historically at what is the next 10-year return of the stock market, when you start buying it in the mid-20s PE, it is literally in single digits. It's like 3-4%, maybe 2% is what the market will return you if you start buying it at a 23 or 24 PE, which is where we're at right now. Now, of course, what bails you out of that and gives you decent returns is if in the next couple of years we have some giant earnings spurt, that we see a big jump in earnings and maybe margins or something along those lines that makes companies just super profitable to just get those earnings shooting up, then you could maybe see that break from that historical norm. But remember, the Wall Street guys are pretty bullish to begin with, and this is all based on forward estimates, and they already know a vaccine is coming, and they've got it in their forward estimates. So if there's going to be a surprise on earnings, give me something other than the vaccine, because that's already in there. And frankly, I don't know what that could be. And that's why I'm not saying the market's going to tank or go down a lot. I'm just going to say it's going to be a real tough go to get, to make it the easy period. Oh, just buy stocks and they go up 15%. And even if you buy the wrong stocks, they go up 10, and no one's really complained. If you buy the right stocks, they go up 25. But we might be in a period where, no, they're going to really struggle to give you low single digits, and in stock selection and a lot of that other stuff becomes a lot more important than it does when you just have these massive advances like we've seen over the last several years.
Well, I've been around a long time, and I know Wall Street is always bullish until it's too late. And, you're past the point. And I've got one more question before we wrap up, but I was saying that as a firm, we're carrying quite a bit of cash because of what we're looking at in terms of what could happen in bonds and what could happen in stocks. And the only way you can insure against that is to really have, to have some liquidity. But a question for you, and I know you're not in the money management business, but if someone came into some sort of a liquid situation today with quite a bit of money, and you were looking at it, I think it's unquestionably a precarious time to start right now. What sort of advice would you give them?
Well, I'd say that, if you want to be a contrarian, your time came and went. That was in the spring when everything was falling apart and people thought, that things were going to get really bad. So that's not the period you're right now. If you're looking at what do I do with my money as I go forward from here, it's like when you buy and sell a business, or it's like when you buy a business and you know that you're paying up for that business You're not getting it cheap. A lot of things got to go right in order for it to work. I'd say, yeah, there is always opportunities in the market. But we might be reverting back to a period where those opportunities might be more selective. I've led the charge on Wall Street I've led the charge railing against Wall Street for the last 15 years that said this is going to be one of the hardest periods for stock picking that we've ever seen. But moving forward from here, it actually might be a better stock pickers environment. Because in the last 10 years, it was, don't worry about stock picking. Just buy the S&P 500 and you're done. Just go buy it and it just goes up and money managers can't outperform it and the like. But as we go forward from here in this kind of environment, there's always opportunities in the market. It's just going to be harder to get them. It's not going to be just as simple as what ETF do I buy? Good, done. And that's it. I'll just check it every week and see how much money I made. Yeah, that's worked over the last 9 months. That's worked over the last 10 years. But I think as we go forward from here, starting at this level of valuation, starting where the economy is right now with the potential of inflation, that may not work. But there will be opportunities in stocks, whether it's large cap, small cap, international, domestic, in real estate, in hard assets, in alternative assets. There will be all kinds of opportunities if one can nimbly move in and out of that. Whereas you could have said that 5 years ago, and that might have been true, but then you've had this big gorilla that's been hanging over you. I could just buy SPY and it just beats everything. That might not be the case as we move forward from here.
It's interesting you say that because that is our contention. I mean, we're basically saying, look, you have everybody in the same mode. You've determined you put all these people that don't necessarily understand income statements and balance sheets, so they just go plug in an index or a bond index, that sort of thing. And so it's going to be interesting to know because they won't have the capacity to look at that and pick and choose. Because if for example, between 1975 and 1983, the market corrected back and forth 20% every year, every single year. And you had to have people that understood what to own, when to own it, and that type of thing. And I happen to agree with you more and more that that's what will take place coming, over the next 5 to 10 years. But Jim, I want to thank you. I know we've covered a lot of topics today. And I really do appreciate it. People could talk to you for hours because you have so much great information. We'll certainly have you back next year. But thank you for coming on. And I do want to say this, if any of you professionals there want to take Jim's research, we'll run a streamer here and you can see Bianco research. And I know Jim would welcome any new research people that want to take his service.
Thank you, Ted. I enjoyed it a lot.
All right. Thanks a lot.